Welcome to the Invested Teacher Podcast with Kyle Pierce, Matt Bigley, and John Orr.
Get ready to be taught as we share our successes and failures encountered during our real-life lessons, learning how to build generational wealth from the ground up.
Welcome, Invested students, to another episode of the Invested Teacher Podcast.
All right, my friends, invested students, we are so excited to dive into episode number 7 here. And before we do, I've got to say, wow, how awesome. We've received so many comments, so many people reaching out to us to say how they're enjoying the podcast. So thank you to all of you, especially to those who have taken a moment to rate and review the podcast. That does so much for us to be able to reach a wider audience of invested students just like you who are eager to kind of figure out how can we do this? How can we take what we're doing now and sort of take it to the next level? So we thought that coming off of our last episode where we talked about the 3 silver bullets of investing in real estate, we thought that maybe we would zoom out and look at different asset classes, different options for us to actually get into investing. Of course, we can't cover them all, but we're going to try to do our best to at least touch on some of the pros and cons of these different asset classes.
Yeah, Kyle, I love that we're covering this because obviously, personally, we're heavily invested in real estate. But I think when people talk about investing, what really comes to mind are things like the stock market, mutual funds, index fund, bonds. I think that's what we kind of all grew up thinking investing meant. Sure. And I mean, for so many people have shared when they've heard our podcast said, geez, I didn't really understand real estate could be so attainable. It's almost like something other people were doing. And I also love that we're including businesses in this. So some kind of a side hustle. This has been one of the other mind-blowing things, and I'll share that point when we get there, just about the power of business, the tax implications of owning a business versus being, say, on a salary and what that can look like. And of course, we're going to revisit our common theme here, real estate and some of the passivity of that, some of the places where you can find relative safety. And as we talked about in our last episode, the reasons why real estate is really our preference as our main investment vehicle, although we have certainly diversified across all 3 of these asset classes.
Yeah. And for each one of these, what we're going to do is we're going to dive into looking at how passive each are, what are our options, and also how they compare to each other, so that by the end, when we compare, when we thought about these 3 different asset classes, like the markets, businesses, and real estate, we can, look at them and go, hey, you know what? Is it more beneficial to invest here, or maybe I've already got some areas here covered, and I want to venture this way. And then you think, oh, you know what? There's a lot of similarities there. Like maybe I'm okay with where I am right now.
Yeah, for sure. And, when you're thinking about investing as well, I think, it seems like one idea, but there are so many like different sections, different sectors, or I guess approaches to investing that you have to really think about. And, for folks like us, like the 3 of us are in around the same age where, we have been working for quite some time. Early on, when you first start your career, you're really looking at like just trying to get going. So you have a lot of things on your plate. You're thinking about, do I buy a house? Like, do I save up for a house? Should I put into a retirement savings plan here in Canada, an RRSP or a 401k if you're in the US, or an IRA, they call it in the US as well. So you're thinking about all these things and like, what do I invest in? But then as you get older, and the other thing I should also mention too, you're also thinking about ways that you can grow your investment instead of necessarily having it immediately pay you back. So there's really a difference between this idea of growth, like actually appreciating or growing your wealth, versus actually creating cash flow, which is something that people heading into retirement tend to be looking for. So you may have heard this from your bankers where, you go in and you talk about investing and they start thinking and they say, wow, the younger you are, the more heavily weighted we're going to be into more of like a growth approach to your portfolio. And then obviously the older you are, the closer to retirement you are, they start to go the other way. And they say, well, it's not about growing your portfolio anymore. Now it's about taking your portfolio and using it to sort of spit off cash that you can live on. So this might be retirement income. It could be used just to sort of supplement your retirement income that maybe you're receiving through a pension. But ultimately, it's almost like over time, we move from this, growing and appreciating your investment into more or less saying like, we don't mind if it doesn't grow a whole lot. We just don't want it to go down to zero, so I have none left. So there's this balance we need to think about. And when we're looking at these different investments, which we're about to dive into here today, really think about where you are in your life and like what stage are you at. Like, when you're thinking like, do you really have a need to try to grow your portfolio, grow your wealth, or are maybe you approaching a stage in your life where you actually need some cash flow to actually supplement your lifestyle or to allow you to maybe retire from your job?
The first one that I'd like to talk about here is the one that I'm actually, to be quite honest, have been the most intimidated by and find the most complicated. And you don't want to be really upfront about that, because when you're learning about this stuff, I mean, the learning curve, feels like it's just a straight slog with some of the stuff. It can be really scary, really intimidating. And while I'm so comfortable in real estate, admittedly talking about the markets, talking about stocks, mutual funds, index funds, bonds, I got to be really honest and say this is the one that I was always intrigued by, but just so darn scared of. And just, I felt like, I don't want to call it a conspiracy, but it just feels like there's so many layers of complexity to understanding the markets that it's almost like there's an intentionality around how complicated it is. It's almost like you need to hire someone to give you advice to do this. And those people then charge you, a percentage, no matter the return that you get. And so I found this to be, intimidating to learn about. And Kyle, you've certainly recommended some great books to help me understand, how we analyze a stock from the fundamental perspective, then how we get into the technicals as well. But it feels to me, as a very novice stock investor, that there's only one way to make money on a stock, and that's if the stock goes up in price. As a real estate investor, I'm saying, hey, wait a second. I've got 3 ways to make money in real estate and only one in the stock market. And I can't have any control. For example, right now I own some Nike stock that I've had for a while. I bought it at a higher price. It's, come down, didn't sell it in time. So I'm just hanging on to it. I can go out and buy some more Nike shoes, but that's not going to impact the stock price. Whereas if I own a rental property, I can help appreciate that property. I can force it through improvements, or when someone moves out, I can increase the rents.
Right.
So admittedly, the markets are both intriguing. We've all heard about Warren Buffett and all of the other bajillionaires making their money in the markets. Kyle, I'm going to really need to lean on you and John for a little more experienced take on the markets as a more experienced investor in these things.
Right. Yeah. And I have to admit the exact same. And I think there's a lot of people admitting the same thing. They're nodding their heads right now, Matt, when you think of the stock market as an intimidating place to put your money, especially coming from, the teacher side, the safety in our pensions, in our wealth, that's building over there, managed by our pension companies and our pension funds that we don't have to touch. And it was like, remember that mindset? It was like, I don't have to worry about it. Because so when I thought about the stock market, I thought, wait, that's way too risky for me because I've already got this pension over here. I'm just going to let that roll. And I don't want to like mess anything up here. So there's definitely kind of that scariness to investing in the stock market. Or the other way is like what you said, you swing to the other side and you say, I've got maybe I'm going to put it in the mutual funds and I'm going to have somebody manage these things. And it just takes all of that kind of thinking out of it, which is a very passive approach. And the stock market can be very passive but in a sense, if you kind of go down that road of someone else doing a lot of the managing for you. But I'm going to comment on something here, Matt, that I think can push back a little bit when you said that the only way to make money in the stock market is if the stock is going up. And you're when we're comparing that to real estate, that's the same as the appreciation. And I like how you have more control over your real estate by forcing appreciation by making improvements to the property, or getting, you're increasing your cash flow on the rent. And you said you can make money 3 ways. We talked about that last episode, and you compared it to saying I can get cash flow out of this and my appreciation can go up. So if we think of the stock market for a moment, if I buy your Nike stock, or I buy another type of stock, maybe specifically a dividend paying stock, then my appreciation might go up if the stock goes up. So that's the same as, your property value going up. But if you have a dividend paying stock, what's happening with a dividend paying stock? You're getting a piece of the pie every quarter, or every half year, or every year when they issue dividends, which can be seen like cash flow. You're getting a payment from the company that's participating in that stock, or in that profit sharing that's happening right there. So if your stock goes up and you're getting a payout, depending on how much stock you own or as a percentage, you're getting a little bit of cash flow there as well. So there's actually a couple ways you can make money on the stock market if you're investing heavily, or not heavily, but if you're investing wisely into dividend paying stocks. And there's lots of people who are only investing in dividend paying stocks with the purpose of getting those dividends and taking that cash flow and living on the cash flow as like their income. They've got a significant wealth built up in dividend paying stocks. Maybe they're in the very safe dividend paying stocks, or the dividend aristocrats, which are the stocks that have been consistently paying dividends year to year to year to year and never missed an increase in paying a dividend. We're investing in that. Then the people are living off the dividend payments, just like living off your cash flow from your rental property.
I love it. I love it. So great clarification there. There's, I would say, like lots of stocks, especially if you think about that growth versus cash flow intro that I had sort of mentioned. It's like, you'll notice that stocks that are growth stocks tend to not have dividends. So
Right.
if there's this
Not yet.
Yeah, like if there's this like thought that, hey, it's gonna, go to the moon, like some of these startup companies that people all, sort of put their bets on, you'll notice that there's no dividends, but at some point, hopefully they'll turn a profit, and those profits will then be shared with the investors. And then on the other hand, you have some that have a dividend. And of course, some of these these established companies that have cash flow may have some dividends to actually pay out. But I do want to once again just comment, just like you, Matt, I felt the same way for the majority of my life around the stock market. I had put some money into some mutual funds, just kind of blindly based on, what my, big bank rep had sort of recommended. And again, better than not investing. Do not get us wrong here. We are not trying to suggest that is not a good idea. But one thing that I didn't like about it was, as you mentioned, I just felt like I didn't have any control. I also just felt like I was just blindly trusting and sort of just hoping everything would work out. And then, you go on to later find out that, banks take a pretty good chunk as what they call a management fee for mutual funds. And there's actually like these things called index funds out there that have like a much, much lower fee, like by like fractions of the amount. And they could actually do the same thing. And, when you think about like trusting someone who's trying to help you, and then you sort of find that out down the road, you sort of like lose trust in it. And the big thing, it comes back to me, or comes back to this for me, is when I began truly wanting to invest and I was trying to figure out like where I wanted to start focusing my time and attention, I just felt like having a physical asset, that place you could go visit. I could go knock on the door and go visit my tenants if I really wanted to. The ones in the US, it was harder. I'd have to get on a plane to go down there. But I loved knowing that there was this thing. Whereas with a company, don't get me wrong, I don't think Nike's going out of business. I don't think there's a lot of these big, sort of important companies that have been around for a while are going out of business. But there is something to be said about actually owning like an actual thing, to own land, dirt, and a building versus owning sort of a piece of paper that sort of promises to pay me a certain amount in a dividend or whatever it might be. But that doesn't necessarily mean that the stock market's necessarily bad. There are, like John had mentioned, these dividend aristocrats that are actually stocks that have been paying dividends for, is it like,
I think 100.
Is it 100 years?
I think there's like 50 years, and then there's like dividend kings, and then there's dividend there's a series. Like if you've been paying dividends for 25 years, you are, we should have looked this up, Kyle.
Yeah, but, you can look it up while I'm sharing here, but ultimately it's like these dividend paying companies typically are companies that have been paying. And when we talk about these aristocrats, they're companies that have not missed a dividend payment for like decades, right? Like we're talking, you can
it's
almost
an increase
guarantee it. And they typically are increasing over time. So that could be a strategy that's helpful for you. But if you're in that growth phase of your life where you want to grow your portfolio, maybe a dividend paying approach isn't necessarily where you are. Now, if you are, on the other hand, you're someone who has a lot of extra money sitting around, then maybe that might make sense for you. But if I got into real estate where I was going like, I really want to actually try to accelerate my wealth, my actual net worth, I knew that I was going to have to do something different. And I didn't want to like, YOLO on some stock that I had no idea about. I wanted something that I felt like comfortable and confident to invest in. So for me, it was real estate. But when we actually look at stocks, so you've got a couple ways you can make money. You can make money in appreciation. You can make money in the dividend if it is a dividend paying stock. And it can be passive, which is a benefit or an asset. But I would argue that if you don't want the feeling that Matt and John, you described it too, and I'm describing, which is this feeling of like not knowing, like I don't want to feel ignorant in this investment, then it's probably not going to be so passive, right? Because you're going to have to actively learn, and you're going to have to actively sort of investigate to determine like, what should I be investing in? And then, there's this whole thing called like the macroeconomic cycle that's going on as well. Like, are they always going to be okay? Or are there going to be times in the economy, in the economic cycle, where that particular stock or that industry sees a downturn? So there's a lot to know there. And, again, me personally, if I'm putting my money there, I want to make sure that I have a clear understanding of where I'm putting that money and whether I'm going to see that money come back to me.
Yeah. That's a good thing. I think Matt, you were I think you had a question about kind of thinking about comparing real estate back towards stocks in a way about leverage. Is that true?
Yeah, I think for me, I see everything through the lens of how does this compare to real estate? And obviously this comes down to everyone, it comes down to their comfort level and their area of interest. It's like, if you spend all of the time that I have learning about investing in the markets, then that would be something you'd be really passionate about and interested in. So when I think about some of the tricks or some of the, big ideas in real estate investing, like one of them is leverage. So you can buy an entire property with just 20% down. You can own 100% of something for 20% down. So because I'm kind of curious, and maybe Kyle, you can help answer this question. Like, is there such an advantage or opportunity in the stock markets? And maybe this actually makes me think sorry guys, I'm just going to stop there for a second. Fuck.
No problem.
Ali, you're going to cut that and we'll jump back in. So when it comes to buying stocks, what kind of dollar figures are we talking about, maybe compared to real estate? I mean, can you get started with a relatively small amount of money? I think some people are intimidated by the amount of money involved that you tie up in real estate. So maybe how do the two compare that way?
Yeah, for sure, for sure. And you can definitely, depending on where you're purchasing your stocks or what brokerage you're using, certain brokerages will actually allow you to leverage your stock portfolio. Now, again, in doing so, I personally feel less confident doing that than I do with real estate. And I think one of the main reasons is because the actual purchase of the investment, which is the investment property, the tenant is going to be the one paying that leverage back. Whereas with stocks, if you're, let's say, leveraging money to purchase stocks, are you going to have that same cash flow coming in? So for example, for those who are maybe new to dividend paying stocks, like, a 4% dividend, meaning like, if you invest in $100 stock and the dividend is 4% per year, you're going to get $4 at the end of the year. They usually do it every quarter. They would split that up. So you get $1 every quarter. So if you borrowed, most of that $100 to buy that stock, it's going to take you like a really long time to pay it back. And that's assuming that, the dividend keeps on going and everything's going in the right direction for you, but there's no additional cash flow. Maybe there's appreciation, right? I'm sure over time the stock will go up if it's a dividend paying stock. But it's just not as common to use that approach. And I would argue that if you were to look it up, most people would say that's like a really risky practice. Whereas you don't hear people saying, you might hear some people saying real estate's risky. Every investment has risk involved, as you know, but you don't see as many people sort of going like, whoa, like borrowing against your real estate is a really, you really need to be cautious when you do that because it is such a common practice. It's almost uncommon. It's almost like hardly ever happening where people just buy an entire property without any sort of money owing on it, simply because it's not leveraging your money in a positive way. You want to actually maximize the leverage you can get on a real estate property because, again, it's such a, over the long run, such a I don't want to use the word safe, but it is like a trusted asset class that we know is scarce and we know everyone will need. Right? Like there is no guarantee that Nike will be around 5 years from now, despite the fact that I believe it to be the fact that it will be around. The reality is that everyone will need property and everyone will need a place to live or reside. And therefore, just in that simple comparison or that simple fact, I personally would not advocate for people to be leveraging up their stock portfolios unless you are like really confident and have like a very systematic plan. Like think about the systematic plan that we have when we purchase real estate property. There is a plan in place and we are going to follow that plan. If you go into doing this with leveraging up your stocks or your bonds or whatever portfolio you have, and you don't have a crystal clear plan on how it's going to play out, then I feel like you're really, you're really playing with fire there.
For sure. For sure. And then another side that's, I guess in a similar way of leveraging there is the idea of buying and selling options on your stocks, which is like, we will go into this in another episode, but you were referencing, Matt, that when you can buy a property for 20% down and you get access to that property and you get the benefit of that property going up, or the benefit of that, or the risk of that property going down, but it only had to pay 20%. So stocks also have a similar thing. When you buy the option to purchase, say 100 shares of Nike, you're paying a lower price. You're paying a premium to pay for the option of that stock. Let's say I buy one option, call option to buy that stock, and then if the stock goes up, I get the advantage of that going up because I'm purchasing the option to buy it at a certain price. And if it goes up, I could then sell it at a profit at that point. But that also, like Kyle said, is a very risky type of thing. And we can go into that in detail in another episode, but it's a way of, you get control of a stock for a certain amount of time with a lower amount of money invested. So you can invest a lot lower but you also get the control of how that stock moves during that time period when you invest with options. All right, now let's move on to our other comparison with real estate and looking at another asset class, which it can be a little bit it's a little bit more active than say stock investing or real estate, which we've been talking about as a passive type investment, like stocks being, you could put your money in those stocks or put your money in the mutual fund and advisor or put it in this index funds, and you kind of like set and forget. Lots of people do that. You could be a little bit more active if you want. But when we move into this other asset class, we can think about businesses, right? So if you can buy businesses, you can sell businesses, you can make your own business as a side hustle. And businesses also have these same opportunities, these same ways to make money, because you can, just like in real estate, you have some cash flow. Your cash flow is equivalent to the profit you pulling off the business. Your business can go up in value, just like the property will go up in value, just like the stock will go up in value. And I think it's in comparison to what you were saying, Matt. If you are running and operating your own business, then you actually have, it's like, and this is also what you were saying, Kyle, it's kind of like something tangible, something that you are actually involved in, something that you could help appreciate in the value. So Matt, you were saying you like that you could force the appreciation on your home if you wanted to get more appreciation on that. You could do the same with a business. You can put a lot of work in your business to appreciate that business and make the business value go up. You got a hand in creating that business. Whereas in a stock, you're buying a piece of a business, but you're letting someone else control whether that business is going to appreciate in value or not. So buying a business, operating a business has those same benefits of appreciation and as well as cash flow.
And John, I've had a personal experience. I currently own, at least partly, I own three corporations in part. I've got a real estate investing.
You almost forgot
company.
one there, Matt.
Well,
he's got too many.
A lot of them.
He's like, oh man, I got so many businesses, I can't even keep track of them.
That's a good problem to have, I suppose. So I own a holding company with Kyle called North Shore Properties. I co-own a company with my wife where, she does some design consulting, some staging. We also run our Airbnb property through this company, and it would be considered a passive company as well. And then as a realtor, I own an active company. And so I've got a lot of experience with company ownership, and I've learned so many lessons about this. And this is a huge, huge tool to wealth building in my experience. And I think, excuse me, some of the epiphanies are really around, I'm going to say, first of all, the tax advantages of a corporation, of owning a company versus being a salaried employee. I mean, let's say a typical teacher makes around $100,000. I mean, what's that tax rate? What's that after how, of every dollar you earn, you're paying what? 51% in taxes, 53% in
after
taxes.
A certain amount. Yeah.
Right. And obviously it's a graduated tax scale here in Canada, but you are heavily taxed, and never mind, union dues, benefits, the money going to your pension plan, from that 100K, you're netting a relatively small percentage of that relative to what that six-figure salary sounds
65%.
Like. Okay. That's huge, right? That's huge. And listen, it's a perspective, and it sounds like a complaint. And of course, whether you're a nurse, a teacher, an auto worker, we're blessed, and we've got that margin of safety there, but you're not going to get wealthy. And that's the whole point of this. So when you own a business, my active business, for example, my realtor business is taxed at 12.2%.
As a corporation.
That is a corporation. That is an active business. That is a big
There's people that just threw their phone, Matt, and now they're not listening.
Now there's a caveat there, Matt, though, like that the business makes money. You are separate from the business. So
that is correct, John.
There's a couple things you have to do as a business, but the business has to pay tax like its own entity. It is its own entity. But if you want to pull money from your business, there is a few options that you have to do there that kind of make you think that you do have to consider as well.
You're right, John. And part of owning a business means you need a power team. And part of that power team is having a great accountant. And so I think that's been something that, I mean, I love my accountant. I'm on the phone with him all the time, emailing him all the time for advice. And so it's almost like you have to admit that you don't know and can't know everything. And you shouldn't think that, someone like, I don't do my own taxes. I want someone who's an expert, who's much smarter than I am in this particular area, to be giving me advice on tax strategy. And so I think part of owning a corporation is really learning to get tax smarter. Right. And that's a big difference from maybe someone who's, like someone whose dad said, no, you do your own taxes. Someone's got a friend whose grandpa still does their taxes, and that's awesome. But to me, I'm all about expertise and leveraging that expertise. So I think that power team is essential. Got a great lawyer as well, constantly, talking to him about various things to do with the corporation. And so that corporation means you need to bring on more of a team as well. And so you're right, the corporation is taxed at that 12.2%, and you need to find ways to get that money out. But it actually means, the other big thing is, it means you need less to live on, because some of your expenses are covered through your corporation. For example, as a realtor, my vehicle, I bought it through the corporation. My cell phone paid through the corporation. Now, if I'm on a meal out with clients, it's paid for through the corporation. And so your expenses are actually, marginally, or even in some cases quite a bit lower, because those legitimate expenses that you are using, to make money, become things that become business expenses. So in terms of what I need to live on, it is much, much lower as an entrepreneur owning a business than it was as a teacher, where every dollar I got in my bank account had been not only had I paid income tax on it, but then every dollar I spent, I was also paying HST as well. As a business, I get some or much of that HST back. That's crazy to me. Some real advantages there to owning and operating businesses.
I love it. And you brought up some really important pieces there. And there's something, we've talked about this before. Now, first off, I must say too, Matt, I'm thinking now, as we're recording this, I'm like, we probably shouldn't have let Matt go first. Because when he's like, wait, I got a corporation under here, I got one over there, so some people might be listening going like, I don't have any corporations. Like, what the heck? So, we probably should have saved Matt for last. However, what I think is really important, though, is how important thinking about these things may be. So if you're serious about doing something other than, let's say, investing in, stocks, bonds, mutual funds, index fund, doing the stock market thing probably doesn't make sense. I say probably. You obviously should look for your own tax advice on this, but it probably is not going to make sense to like even think about corporation. But if you're like listening and you're going, wow, all these episodes, like these three guys really like real estate, and I want to, begin growing a portfolio that's going to expand beyond a handful of properties. I'm using no, number. I don't want to tell you, because I don't want someone to email us and say, you said after 3 properties, you should do it. But like, if that's your plan, then thinking about those things ahead of time can be really helpful, whether it's owning an actual business, like maybe your real estate corp, like you have, or whether it's because you want to buy investment properties and you want to run it like a business. So, Matt, you and I, when we began this journey together, that was something that we had discussed when we had the property that we wanted to purchase. And it was actually a big discussion where we were chatting about, like, if this is just a one-off, then it probably doesn't make sense for us to open up a corp. But if our plan is to continue accumulating more property and building that wealth, which both of us were sort of thinking is like, we want to grow our wealth. We were not looking for a massive amount of cash flow necessarily. It was to build our wealth so that we could cash flow later in life. And, we made that decision together. And, because of that, we are in a position where, again, we have that opportunity to spend less after-tax dollars. So something we've said a few times when we go out for a meal to discuss a property, or when we go out to, have a meeting about anything related to the corp, we think about it. And I say it often to both of you guys whenever we do this, is like, when we spend $100 at a dinner, that $100, for us is a lot more working time if it's out of our personal income versus out of that active or that corporation income. So like you had said, if it's like just over 12% taxes over there, it's like, 80 for every $100 you make, you're only keeping 88 in the corp. Whereas for me as a teacher, I'm keeping more like 60 of those $100. So that means like I have to work longer in order to keep more money in order to pay that bill. And that is such a powerful opportunity. And, something that I want people to think about if you're a teacher like we are, if you're a nurse, a doctor, whatever you are, maybe you're in a job that you love and it is a salaried job, there might be an opportunity for you to think about like a side hustle business of some type. And, maybe I'll turn the tables and let John sort of chat a little bit about that. Because the side hustle business, if you look at it as instead of trying to supplement your current lifestyle, you can use that business as almost like your seed money to help you grow your portfolio so that you can build your wealth over the long term.
Yeah, a side hustle, sometimes that's daunting because I think most people who are listening right now, and if they're in those jobs like teacher, maybe you're a policeman or a nurse, or you've got one of these jobs that have a lot of stability, a lot of benefits. Oftentimes we say we don't have a lot of time, right? We don't have a lot of time to do these other things, or I have to spend time with my family. When would I spend time to do something else? Which is a valid concern about thinking about us starting a side business or doing something on top of what you're doing on your day job. So there is that concern for sure, but the idea of starting that side hustle could be something that where maybe you are already doing something already and it can be pivoted into a side business. I know that there's lots of people who have turned some of these hobbies that they do into side businesses. Kyle, we did this with our math business. We were regularly sharing math lessons to other teachers. We shared them to each other. We shared them on Twitter and on Facebook and on social media, and we blogged about our math lessons, and that ended up, I think we did that for a long time. And we did that for a long time, not thinking about a side hustle in one respect or another. And then it turned into selling and helping teachers become better at math by an online course. And then that online course turned into a few other things. And that turned into a side hustle, even though we never even dreamed of it becoming a side hustle where it could be our wealth generator over time. And I think that sometimes is what you want to look at. What are you doing on the side now that you don't think is a side hustle, but could be pivoted into something where you design an online course, or you take an extra step and sell some coaching to somebody, or maybe you're doing a couple other things to help someone else. So I think that part, but I think the side business in general can be a great place for you to generate the cash flow that you're looking for to invest or get started with real estate. Because I think even though your side business or your business can generate cash flow, which is your profit, it can offset your taxes, like Matt has described. It can grow in value over time, like appreciate. There are a lot of advantages to having that corporation or that side business. But I think a great strategy, and this is the strategy we employ here, is that you can use that side business and take the cash flow, instead of padding your lifestyle and making your lifestyle kind of creep up and all of a sudden you have to keep that going, is take all of that extra, and then now that's your seed money to buy your first real estate property. And then that turns into its own cash flow. We're a big fan of taking money that's coming in from somewhere and buying assets with that spit out more money. And then that's like a machine that keeps going. And so then it's like, hey, you want to buy a new car? You want to take your, you're thinking about, hey, I would love to have a new lease on a car. I just want that new car. Instead of going and buying the new car and paying that monthly fee, instead, think about taking your asset over here, buying an asset, wait a little bit until that asset spits out cash flow, and then use the cash flow to buy that car or that lease, because that's going to keep coming back and you never are going to lose that over time. That's always going to keep spitting money, and you've just reinvested this into this machine that can generate your wealth at a higher level.
And John, what I keep thinking about as this conversation unfolds is that this is all about decisions for people. Do you have to do a side hustle? Do you have to start a business? Not at all. But I think our listeners are people who are interested, invested in growing their wealth, in attaining another level, in breaking maybe out of the confines of that comfort zone that so many people are in, those proverbial golden handcuffs. So if you want to buy the car, buy the car. If you want to learn about options trading or stock market, investing in the stock market, do that as well. So this is really all about decisions for people in terms of how they live and what they want to attain. And so for me, that decision has been real estate. I think that there is such a degree of safety in real estate. We know that the fundamentals, when we talk about analyzing a stock, like when we look at the fundamentals of real estate, we look at the population explosion in Canada, we look at 500,000 immigrants coming into the country this year, we look at all the good things happening economically in Windsor-Essex, we look at the shortage of housing already. Those fundamentals suggest to me that over the long haul, and just like with the dividend aristocrats, if we look at the historic trajectories of house appreciations, home appreciations, yes, of course, it's gone up and down. But over time, housing has always gone up, and that makes me feel really good and really comfortable. We've talked so much about real estate, but we'll kind of, I guess, wrap here, by referring to those previous 6 episodes and talking about all of these amazing opportunities in real estate, these 3 different ways to win, the passivity of it. Kyle and I were just having a conversation today with a potential JV partner who was really bright, well-educated, worried or scared to maybe start in real estate, but very, very curious to do so, and even willing to try it on their own. We really reached the conclusion. We said, if we do a property together, you get all the safety of using us who are experienced, who can find the property, who can vet the property, who can ensure that this is both a fundamentally good property and a technically good property, and then we can manage it. And you can learn as you go. This is like your property training wheels. And if you like it, you buy the next one on your own. Or if you've liked the passivity of not literally having to do anything, you buy the next one with us as well. And we continue down that path. And that's the beauty of all these entry points into real estate. It doesn't have to be scary because you can partner with people, us or someone else. So the scariness of the stock market doesn't have to be there. You also don't have to have an active business like we talked about with businesses. Again, you can buy something and it is going to generate cash flow. It is going to appreciate, and that mortgage is going to be paid down. Those 3 ways to win, as we talked about last episode, are just incredible. And so that's the reason I always come back to real estate as my favorite investment vehicle.
I love it. That's a great way to summarize all that we've discussed. And again, as we've mentioned, think about this episode, think about the other episodes we've had, and where do you feel like your journey should begin? Or maybe you've already started on a journey. Maybe you're really interested in understanding the markets and the stock market, and you want to take a deep dive. As long as when you decide on what that thing is, that you do that learning, or you find someone you trust to do that learning with. So whether it's real estate and you find a JV partner that, you can work with and learn with and from, awesome. Or maybe you're going to take a deep dive and learn all about it yourself. And the same is true in the stock market. You don't have to go it alone there, but you just make sure that you find that mentor, that guide who is going to help you along the way in that journey. But as long as you're doing something in order to keep that ball moving forward, and ensuring that you're essentially setting yourself up to take advantage of the the amazing things that compound, we'll call it compound interest, even though I know we're not getting compound interest, so to speak, on real estate, but the reality of growth over time and being able to take advantage of as many of those silver bullets in investing as you possibly can. Take action, do something. Check out our book list at investedteacher.com/books. And you can pick up a book that sort of calls out to you as to where you are and how you're going to take that first step. Whatever it is, make sure you do something. John, what's your big takeaway here from today's conversation that you want people to remember?
I think my big takeaway is that of the different classes we looked at with stocks, businesses, and real estate is they have similarities against all three, which I find that comforting, that if I'm already investing in the stock market, I'm taking, or I now maybe have learned some strategies like dividend investing that can get the benefit of not just appreciation or the stock going up. I can also get the dividend and reinvest those dividends so I get more compound interest. Or maybe I'm at the stage where I want to take my dividends as income, and treat that as passive income or cash flow, just like you're taking cash flow from your rental property. I like that there's a lot of similarities in all three of these asset classes. And I think it doesn't mean that one necessarily is better than the other, but being involved in all three, I think in understanding that how you can generate those benefits is the most important takeaway here.
Love it.
Love that, John. I think for me, I love as teachers, especially, we're such learners. I'm a fanatical learner, podcasts, books, talking to other people. I just want to sponge it all in, because truly success leaves clues. And so I think my big takeaway is for you to learn about all three of these and then make some action, some decisions about which one to pursue. Don't get stuck. I talk to investors all the time that say, I've been thinking about doing this for 1, 3, 5, 10 years. So I think that combination of learning, and the learning can be fun as you delve into these three things, combined with some action is really the big takeaway for me from this great episode.
I love it. I love it. And you know what? I love the takeaway of taking action. And here's how you can take action right now. Get started by leaving us a review and a rating on your favorite podcast platform. Subscribe. We're over on YouTube as well. Maybe you've got us in your earbuds right now, but you could be looking at all of our beautiful faces right now as you're listening. If you had subscribed to us on YouTube, that is at Invested Teacher on YouTube. So youtube.com/Invested Teacher, as well as all social media platforms. Do us a huge solid so that we can reach an even wider, eager invested student audience.
We'd love you to share this podcast with your friends and family. I can't tell you how many people have reached out to say, I'm sharing this with my husband, my wife, my dad, my kids, whatever it might be. All links, resources, and transcripts from this episode can be found over on our website. That's investedteacher.com/episode7. Again, that's investedteacher.com/episode7.
And if you haven't yet got our wealth building blueprint, which is our 5 ways to build your wealth, get on over to investedteacher.com/blueprint, investedteacher.com/blueprint. Download our PDF that can guide you on how to build your wealth, so you can get started right away.
All right, invested students, class dismissed.
Just remember, the content that you heard here today is for informational purposes only, and also entertainment purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice.